Hey everybody, this is Coach D with TackleTrading.com here to help you define inventory turnover. Inventory turnover is the ratio of annual sales to average inventory and is a method to measure the speed at which inventory is produced and sold. A high turnover ratio is considered a good sign and a low turnover is an unhealthy sign indicating excess inventory and or poor sales. Inventory turnover ratios indicate how many times a company has sold and replaced the inventory during a given period. Analysts can divide the days in the period by the inventory turnover to estimate the days it takes to sell the inventory on hand. So again, inventory turnover equals sales divided by average inventory. Calculating inventory turnover can help a business make better decisions on pricing and manufacturing runs and how and when to purchase new inventory, as well as when to leverage and move excess inventory. Here's an example of some data that we can take a look at here again on Apple computers, where we can look at the activity ratios and their inventory turnover. And we can see that they've got a 37.46 inventory turnover ratio. And again, that's down 43.99% year over year. And here again, we can see a steady downtrend in their inventory turnover ratio over the last 5 years. Again, by comparison, here's Microsoft. We can look at their inventory turnover ratio. They have a ratio of 11.5. And again, that's actually up 11.71% year over year. And here you can see where over the last 5 years, they started out at around 10.72, dipped a little bit in 2014 and 15, and we're seeing it back up to 11.5 inventory turnover ratio here for the year of 2017. Now that gives you an idea, again, how quickly these two companies are able to turn over their existing inventory, or what the typical turnover rate is, which can help us determine how healthy the company is and how quickly they're making those sales.